Good morning, and thank you for joining us today. My name is Trevor Schusler, and I am a Vice President within our Client Strategies group here at Research Affiliates. It's our pleasure to host this webinar, Diversification is the Free Lunch Worth the Heartburn? Before I hand it over to my colleague, John West, who heads Client Strategies, I wanted to highlight the launch of our advisor page on our website, researchaffiliates.com. There you can find links to advisors-focused resources like this webinar. We also have on that page our advisor publication series. That's an 8-part series that covers many of the common mistakes that advisors make, and hopefully will arm you with the tools and knowledge you need to deliver better outcomes for your clients. So far we've published 3 papers, those papers being on return expectations, risk, and building portfolios, all of which John will touch on today in the webinar. That page also includes our interactive tools, those primary tools being Asset Allocation Interactive and Smart Beta Interactive. The presentation that we will be going through in today's webinar, you'll see many different slides and exhibits that come from that asset allocation tool. Just as a reminder, that tool was launched a couple years ago, but it was relaunched this year with far more functionality to it than in the past. That will give you our return expectations for a number of different asset classes, allow you to build portfolios, and give you a sense of valuation for a number of different asset classes. Lastly, I'd just like to encourage you to stick around till the end of the presentation because we will be highlighting a few of the other resources we have in the pipeline for advisors. And that includes information on our advisor symposium. So with that, I'll hand it over to you, John.
Great, thanks Trevor, and thank you everybody for joining us today. As Trevor mentioned, we've published 3 papers in our series of publications designed to help financial advisors produce better client outcomes. And those 3 papers revolved around expected returns, risk, and building portfolios. And when you think about all 3 of those concepts, what they all have in common is diversification. And so we're going to talk about how diversification is done over the past 5 years, broadly speaking, what it's likely to do in the future, and how we can prepare clients to take advantage of it. And as I go through this, I want you to think about 2 quotes on diversification. The first one is from Harry Markowitz, obviously father of modern portfolio theory and a longtime member of the Research Affiliates advisory panel, who called diversification the one free lunch in finance. The other quote is also from a Research Affiliates friend and colleague. That's Jason Su, who now runs Rayliant Global Advisors. And Jason said, diversification is a strategy of maximum regret. So keep those 2 quotes in mind as we walk through this, because they are both actually true. And it's really up to all of us that work with clients to find a balancing act between both of those quotes. So, how has diversification done in general of late? And you can see on page number 4 that over the past 5 years, on a classic risk and return look, that it's been a really tough environment to be anything but a mainstream U.S. equity investor. This is the classic risk-return chart where on the vertical axis we have your real after inflation returns of the past 5 years annualized, and on the horizontal axis we have standard deviation or volatility. So the best performer is that red dot at the top, U.S. large, which is proxied by the S&P 500 or large cap blend, mutual funds, which is compounded at nearly 14% per annum over the last 5 years. An incredible run of performance. Nothing has beaten it. So unsurprisingly, a 60-40 portfolio, 60% U.S. stocks and 40% U.S. bonds, has essentially gone along for the ride. It's given us nearly 9% per annum real after inflation returns. And just about any other asset class has given us some combination of lower returns, more risk, or for some of them both. And so certainly when you look at this, you say, boy, diversification is a strategy of maximum regret. Indeed, I view Jason's advice as timeless because when you're diversified, you're always going to have some degree of assets in your portfolio that have disappointed you over recent periods. There will always be some laggard to say, gosh, I wish I didn't own as much of this or as much of that. But in this case, over the past 5 years, any strategy outside of mainstream stocks and bonds, we're sort of saying that about. Now, it's important to remember that diversification can be cyclical. Inevitably, when we're conducting building portfolios and setting expectations for clients on how their financial assets are going to perform, what sort of return are they going to get, we're really talking very long horizons. Indeed, that's the reason why we, on our Asset Allocation Interactive site, do 10-year expected returns. Because really, fiduciary planning should be done on a very long time horizon to sort of wash out the cyclical ups and downs. And when we talk about cyclical ups and downs, there's quite a bit with diversifying assets. This exhibit shows you the relative performance of an equally weighted basket of diversifiers. All those asset classes that we showed you on the previous page, emerging market stocks and bonds, credit categories, inflation-linked bonds, bank loans, and so forth. And when we equally weight those and compare them to 60-40, the green bars means diversifying assets added value. They did better than 60-40. The red bars means 60-40. Mainstream U.S. stocks and bonds were the big winners. The first observation here is this is what diversification should look like. If you get big deviations, it means you have asset classes that are performing very differently over shorter time periods. The second observation is that over the very long period, and this is over the last 40 years, we see these diversifiers have given us about a 10.8% per year return. That contrasts with 60-40 about 10%. So all else equal, over the past 40 years, diversifiers have given us a slightly higher return. I would assert that this is something that is structural and you should expect over longer time periods. And why is that? Diversifying assets are less well known. Less well known assets come with greater uncertainty, they're harder to explain to clients, and since they're not as comfortable, they tend to give you a higher rate of return over time to compensate you for that discomfort. Now, 80 basis points per annum over a very long time period has a very uneven journey. We can see that over the 4 out of the last 5 years, diversifying assets, calendar years, have not paid off. And indeed, we see some pretty big drawdowns. In other words, 60-40 has gone on to massively outperform diversifying assets for much of the past 5 years. Really, the only time period that's somewhat similar is the late 1990s. And as we'll see in a second, a lot of the recent returns of the 60-40 portfolio have been driven by rising U.S. equity valuations, just like we saw during the tech bubble. Now, whenever you have a certain amount of regret, I find it to be a very productive exercise to go back and say, what did you know at the time when you made these decisions? And so on page number 6, what did we know in 2012? Well, we were coming off of, repeating the exhibit of a couple slides ago, this is a 5-year risk and return chart, but done so towards the end of 2012. So looking back at the last 5 years, many of these diversifying assets actually helped us during the global financial crisis and its aftermath. We see emerging market non-local bonds doing fairly well. We see TIPS, bank loans doing better than 60-40. And we see in aggregate, when we combine these diversifiers on an equally weighted basis, they gave a return slightly above 60-40 with a little bit more risk. Some of the, unsurprisingly, the higher risk end of the spectrum, such as emerging markets, EFA, which are international stocks, commodities, and even U.S. large company stocks didn't quite do as well. Why? Because they started with such a hole in 2008 in terms of performance. Now, U.S. equities gave us a real return of about 0% over this trailing 5-year period. Sometimes when you see U.S. equities give you that such a low rate of return, you'd say, well, gosh, maybe they're priced to deliver us outstanding results. Was that the case in 2012 or towards the end of 2012? And as we look at the Shiller PE ratio, and we can tailor this chart to do a Tobin's Q or market capitalization as a percentage of GDP. Some of the other frequently referred to long-term historical valuation ratios that are predictive of future equity results, and you get something similar. So let's just stick with the Shiller for now, but bear in mind there probably wouldn't be dramatically different results. Where were we at the end of 2012? Well, the S&P 500 was trading on a Shiller PE ratio of about 22 or 23. How does that compare versus history? And if you draw a line from that end of 2012 valuation, you can see you really only had higher valuations in a handful of historical episodes. The last decade before the global financial crisis, the tech bubble of the late 90s, a brief blip in the mid-60s, and then during the roaring 20s before the crash in 1929. So stocks, while not giving us great returns in the U.S. Towards the end of 2012, were certainly not priced to, relative to history to get such a great return moving forward. Indeed, when we look at how equities have achieved these magnificent returns, really it's really that red line ratcheting up substantially over the last 8 years, going from a PE ratio of 22 or 23 to north of 30 today. That's a pretty big jump, and one that I would assert towards the end of 2012, only 15 months removed from the bear market of August, September 2011, would have been one that, was it plausible? Of course it was. Was it something that I think advisors would have a lot of comfort in telling clients, yes, your central expectation should be that stocks are going to rise to a valuation level that we haven't seen outside of the tech bubble and a handful of months in the late 1920s. I think most financial advisors during that particular point in time would get laughed out of the room by their clients. But that's what happened, and that brings me to what I think, and we started this series off with, which is what we call the most dangerous shortcut in financial planning. And that's to rely upon historical returns to guide our expectations for the future. Now we show you over the trailing 5 years that 60-40 as of September 30, 2017 has given us about an 8% real rate of return. And if we go back 10 years, it's given us a 4.8%, 20 years, 4.4%, 30 years given us nearly a 6% real return, and trailing 40 years, 6.5%. Real return, real after inflation return. Now most clients would say, gosh, that's good enough for me. I should probably expect that in the future. After all, this is, the last 20, 30, 40 years of a variety of different political regimes, inflationary environments, growth environments, and so forth. So that seems like a reasonable expectation moving forward. But in fact, that's just not accurate when we look at the data. Trailing 10, 20, and 30-year returns for the stock market are actually negatively correlated with the subsequent 10, 20, 30 years. If you get above average results over the last 10, 20, or 30 years, you're likely to have below average results for the subsequent 10, 20, or 30 years. So this is that's the reason why we call it a dangerous shortcut in financial planning. Now, to give you some sense of how we fall into that trap, we look at on exhibit number 9, on the left-hand vertical axis, bond yields in the United States over the last 40 years. And we follow that green line across. It started at 8% and winds up at 2%. On average, bond yields have been about 6% over this time period. They're not 6% today. They're 2% today. Starting bond yields are about 90% correlated with your subsequent 10 years worth of return. So in other words, your starting yield today is what you get over the next 10 years of total returns for bonds. Very strong historical relationship. So we shouldn't count on getting 6% for bonds. We should count on getting 2%. Most people get that. They understand that relationship. Now what about stocks? When we look at stocks over time, over the last 40 years, we've gone from a Shiller PE ratio of 10 to a Shiller PE ratio of 30. We've tripled in terms of valuation ratio. Now, if something triples in price, chances are it's going to have wonderful past performance, but what you're by definition is assuming, if you project that going forward, is those same outstanding price gains are going to continue. And indeed, if bond yields stay at, if we get the next 10 years, this historical relationship where your starting yield of 2% equals your 10-year bond return of 2%, what do stocks actually have to do to actually make sure that a 60-40 portfolio gets you 4% real? We ran the numbers, and it turns out PE ratios, assuming normal levels of earnings growth, have to go to 41. Can they go to 41? Just like the last 8 years or 5 years, they've gone from 23 to 30? Can they, over the next 10 years, go from 30 to 41? Of course they can. But it's our job as financial advisors and fiduciaries to communicate to clients what's likely to happen. And I think for a PE ratio of 41 is a central tendency of what we think, and all the ranges are going to be either above or below 41, I think is a dangerous way to approach the markets and financial planning. So what can we do? Well, if we can't rely upon historical returns, where do returns come from, and what do we know today that can help us plan more reasonably? And we break this return decomposition down that Rob Arnott and Peter Bernstein proposed in a Financial Analyst Journal paper back in 2001, 2002. It's been used by many other people, including Jack Bogle, where we just say, what's the yield of the asset class? How much is that yield going to grow? For Treasury bonds, we wouldn't expect it to grow at all. For high yield or credit categories, we'd expect some default, so we'd expect negative growth. For equities, we'd expect equities to grow their earnings and dividends positively over time, plus or minus any changes in valuation. And I just showed you previously how valuation for equities can bounce around. Now, when we look at these, what are the things we know today? Well, we know yield. Yield's observable. You can get that on your Bloomberg terminal. Growth varies, but not over rolling 10-year periods. Not that substantially. Generally stays pretty close to its historical averages. The big wild card, the thing that moves the most and is the hardest to predict, are changes in valuation. And because of that, on Asset Allocation Interactive at researchaffiliates.com, we give the option of two forecasting methodologies. The first one just gets rid of that really big wild card. It just says, what's the yield plus the growth in the asset class? The other one says, well, if things are trading really rich, we'd expect them to get a little cheaper. If things are trading really cheap, we'd expect them to appreciate a little bit. Has some degree of mean reversion in valuations, and I'll walk you through that here in a moment. So those are the two forecasting methods. Let's take a look at what that would mean for the previous exhibit that we had on U.S. stocks and bonds. So the yield plus growth way of forecasting returns gives us, if we were to say, what's the yield going to be for bonds in 10 years? It just basically says bonds aren't going to move meaningfully a lot in price. So we're just going to be at the same yield level as we are today, it's about 2.5%. For equities, it does the exact same thing. If we're at a Shiller PE of 30 today, I don't know if that's overvalued or undervalued. That's what we're going to have in 10 years. And we can do that for all of these asset classes. And what do we get? Well, with the yield and growth, we get a 3.3% return for U.S. large, 1.1% return for Barclays aggregate. You put them together in a 60-40 basis, you might be around 2.5% to 3%. So even assuming valuations don't move at all, you're unlikely to get 4% real returns from mainstream markets. And even by the time you add in diversifiers, so momentarily I'll show you on a risk-return basis why we think they're attractive, you can see that there aren't a lot of places that are priced in our minds using this forecasting methodology to get you real returns of 4%. What about the second method? The second method assumes we have some degree of mean reversion. If valuation, if something's really expensive, it's going to get a little bit cheaper. If something's really cheap, it's likely to appreciate a little bit in price. So let's talk about this with bonds. If bonds are at a 2.5% yield, and we recently put out a paper on Treasury yields where we said we're really not in a Treasury bubble. Bonds are a little bit expensive, but not the way that you would expect given all the headlines about Treasuries being in a bubble. So if yields appreciate or rise to 3.5%, that would sort of be what this valuation dependent would be, or forecasting methodology would assume. And it's really interesting when you apply it to stocks. At a Shiller PE of 30, which as I showed you a moment ago was somewhat unprecedented over time, what if we get stocks not reverting all the way back to their historical average? We just assume they're going to revert halfway. So if the historical average is 16 or 17, we're assuming it's a little bit different this time. maybe there's something that's just different versus history, and we've written about this in some of our publications. So let's just assume we get halfway mean reversion to about 23. What does that mean for returns? It means that stocks and bonds are, in mainstream stocks and bonds, are only going to give you about 0.5% real. The diversifying assets are, some of them give you a little bit more than 4% real, but again, we're seeing fairly paltry returns over time. So I think the key takeaway of the dangerous shortcut in financial planning almost applies everywhere. But we see big relative differences between these diversifying assets and mainstream assets that have been everybody's heroes recently. Now, when I was in consulting, advising institutional investors on how to allocate their assets, on what managers to select, and monitoring performance, one of the things I really felt strongly about was you should not let these different return forecasting methodologies just go with the one that your clients are going to buy into. Indeed, the first time I went through this exercise after getting the job of head of research was, the very first question after a 60-page PowerPoint presentation was, have you run the numbers to see what 60-40 is going to do? Because I need 60-40 to get 7%, because that's what I've told clients. I said, well, if you want to tell clients exactly what they want, then this is probably not the exercise for you. Imagine if you go to someone else, another service provider, a healthcare service provider, and say, it's really important that you tell me that I can eat junk food all day long, eat a pack, smoke a pack of cigarettes, and by the time 4 o'clock comes, knock down a case of beer. I want a doctor to tell me that that's good for my health. Now, you can probably find someone to do that, but you're really not serving that client's best interest. And so we really need to say, what are the things that we believe in? And when we go through that exercise, what's a prudent thing to do? If stocks are trading only 3 times in history higher than where they are today, maybe the prudent thing to do is to assume some degree of mean reversion. And so when you ask us, we think that's a reasonable thing to do. And one of the experiments I gave some of my former colleagues was, I said, who's your favorite investor? Is it Warren Buffett? Is it Ben Graham? Is it Jack Bogle? And then go Google how they forecast long-term equity returns. And I think that's a helpful exercise. So when we do that, we think it's a prudent thing to do to assume some degree of mean reversion. And so as I walk you through what our expectations are from here, we're really using that forecasting methodology of being valuation dependent. And what do we find today? Today we find that U.S. stocks and bonds, as I previously walked you through, are giving us a very paltry forward-looking rate of return, about 0.5% real. And so 60-40, unsurprisingly, falls somewhere in the middle. And again, this is all from our Asset Allocation Interactive. And you'll actually find the diversifiers as a pre-filled out asset mix, this equally weighted basket of all the dots you see here that aren't U.S. mainstream stocks and bonds. Today, that portfolio is priced to give us about 3% real. You have some markets, like international stocks and emerging markets equities, that are driving that expectation up. You have other diversifiers that we're less bullish on, such as commodities, certainly on a risk-adjusted basis, and tips, which are lower risk, but of course lower returns. But when you put them all together, we see the diversifiers give us about a 3% real expected return for the next 10 years, about 300 basis points better than 60-40, but coming with a little bit more risk, about 11% expected standard deviation versus about 9% expected standard deviation. Now, since we have such a higher expected return, the downside when you run it on a higher expected return is just about the same as 60-40. So in a classical sense, if you're just using Harry's mean variance optimization, you'd say, wow, diversification is a total free lunch. Give me some of that. Now, we are not all rational risk return seekers. We do have behavioral biases. And one way to kind of get some sense of the discomfort that this diversifier mix has in it is just to simply look at the asset mix. And when we look at the asset mix of the diversifiers, well, only 22% is in equities. And then when we break down that equity exposure, we've got 0% in U.S. large stocks, we've got 0% in U.S. small stocks. All of our equities, what little equities we have, are in IFA, international stocks, and emerging markets. So we have 11% each in those. We have nothing in mainstream bonds. And then when we get into credit, we have 33%. When we look at the breakout of that, it's really not U.S. corporate investment grade bonds that are comprising that, or even junk bonds, which a lot of people already have in their portfolio. It's 11% each to bank loans, emerging market bonds denominated in dollars, and emerging market bonds denominated in local currency. Now that leaves an additional 44% that is equally weighted amongst linkers. That's U.S. TIPS, local and foreign cash, which is emerging markets cash, again denominated in local currency. Commodity futures, such as like a Dow Jones AIG index or Bloomberg Commodity Index. Sorry, old habits die hard. REITs being rounding out things, publicly traded U.S. Real estate. So most clients would look at that portfolio and say, I'm really uncomfortable. My just gut tells me, I don't need any analytics to tell me, that's really a maverick portfolio. I'm really uncomfortable with that. Well, on a risk-return basis, they really shouldn't be uncomfortable with it. The downside is virtually the same as 60-40. What's driving their discomfort? It's really this notion of maverick risk. I'm uncomfortable because it looks so much different than everybody else. Keynes wrote about the danger of being wrong and alone. This is a classic wrong and alone portfolio. While it might give you a 10-year return that's superior on a risk-adjusted basis, chances are on a shorter time period you are going to be wrong, and you most certainly will be alone, not owning any U.S. equities. Now, advisors have been walking their clients through this trade-off between having diversified portfolios that look different and more mainstream-oriented portfolios that are more comfortable, but over a longer time period might give us lower returns. What can we add to that conversation? Well, in Asset Allocation Interactive, we give you the ability to actually not just look at the absolute return and expected risk of the portfolio on a standard deviation basis. Let's try and quantify this maverick risk. When we do that, we can select a toggle where we switch our risk measure not from standard deviation, but from a tracking error to a 60-40 portfolio. And here those diversifiers start to look really risky. The return axis, the vertical axis, is our expected excess return relative to the 60-40 portfolio. Our horizontal axis has shifted from standard deviation and absolute returns to tracking error relative to 60-40 portfolio. And what's this show us? Well, the diversifiers now look really risky. They look really risky because this really confirms that gut level feel, boy, I'm not really sure I want to own something that's going to move so much differently than the portfolio everybody else owns. So we get about a 6% tracking error. Now granted, we're getting called a 2.5% to 3% expected return advantage, but it comes with a lot of risk relative to that mainstream portfolio. So the way to think about that is, yes, it's expected to do 2.5% to 3% better, but 95% of the time it's going to be plus or minus 6%. I'm sorry, plus or minus 12% away from that expected return. So the right way to think about this diversifier portfolio is, yes, we think it's going to outperform over the next 10 years by 2.5% to 3%, but in any given year, it's going to outperform by about 2.5% to 3% plus or minus 12%. Now, some people just say, boy, that's a little bit too uncomfortable for me. I don't want to walk in and see my portfolio down 10% to my neighbor's 401k account. Or to the ubiquitous 60-40 that serves as the benchmark to so many of the statements that go out to plan participants. So we can, through Asset Allocation Interactive, blend this diversifier portfolio with 60-40. So if we put half of our money in diversifiers, half our money in 60-40, we get half the expected return, but we have half the tracking error. So now our expected returns now closer to 1 to 1.5% above 60-40, which again compounded over 10 years can be a meaningfully large difference in ending wealth. But we've reduced our tracking error in half. To take a look at what that trade-off looks like, we can simply draw the normal curve with this distribution. The One that's flatter is our diversifier portfolio. You can see it has that higher expected return, that white dotted line. It's expected to give us, call it 3%, round figures, above 60/40. But it comes with that large tracking error. Remember I said plus or minus 12%. And we're going to get those over the next 10 years. Whether it be similar to the Asian flu of the late 90s or the taper tantrum in 2013, these diversifiers will have periods of underperformance, despite, in our minds, giving you a better long-term outcome. If those are uncomfortable for the clients, and we can utilize this tracking error to communicate to clients, you are going to get results here. A financial advisor's job should really be to convince clients of what their risk tolerance is and communicate ahead of time so that when things that are out of normal or surprising happen, they've already been communicated that clients shouldn't be surprised, that these aren't out of normal. And indeed, you can trim that up if clients just view that as too uncomfortable and moving to the portfolio something like 50% mainstream stocks and bonds and 50% diversifiers. So we have the tools in Asset Allocation Interactive to have reasonable conversations so that we can prepare clients that diversification is a superior long-term strategy, but one that requires patience and can show people the outcomes that could happen ahead of time. And so when we're thinking about summing things up, I think both Harry, who claimed that diversification is the only free lunch in finance, is absolutely right. Over a long time period, diversification is one of the few things we can reliably count on to reduce risk and increase returns. But we have to have an extraordinarily long time horizon. Now, diversifiers will disappoint over the shorter term, and it's up to us to make sure clients are prepared for that and can weather the inevitable storms. And so I think both Harry is right. It is a free lunch, and I think Jason's right that it's a regret maximizer. And I think Harry summed it up best when he said the most important job of a financial advisor is to get their clients in the right place on the efficient frontier. That's really that first exercise, that classic, what's the expected return and what's the expected risk of the portfolio? And diversification obviously comes into play there. But their number two job, and Harry called it a very close second, is to create portfolios that their clients can live with comfortably. And advisors can create the best value proposition if they create portfolios that clients can stick with over the longer term to reap the free lunch and to not have too much regret. And so with that, I'll end the formal portion of the remarks and hand it back to Trevor.
Thank you for that overview, John. While we're compiling the questions for the Q&A segment, I'd like to take a quick moment and remind listeners that many of the exhibits referenced in John's presentation can be found and recreated and even customized on our Asset Allocation Interactive tool. One other thing I'll note is that earlier this year we held a webinar called Forecasting Asset and Portfolio Returns that guided users through the tool and helped explain how they can achieve better outcomes for their clients using the tool from our website. So I encourage you to go onto that and look at that webinar. With that, let's now move on to the Q&A section of our webinar and answer your questions. So it looks like we've received around 50 questions already. So let's start with one of the first ones. John, how do you explain to a client that an 8% return expectation should be closer to 4%?
I think the first thing to do is to get what clients understand. They understand that interest rates have declined substantially. Anyone who has a mortgage understands that. That's a positive on the mortgage side. As a borrower, as a saver, it's a negative because we have much lower yields. And I think people understand that if they buy a treasury bond at 2%, it's going to give you a lower return than if they buy a treasury bond at 5 or 6%. Now, financial assets such as stocks, they're just simply shares in a company, come with a yield, and if prices rise a bunch, you're going to get a lower yield. And you need earnings and dividends growth to overcome that. And so it's historically very unlikely that when you get substantial rises in the price of equities that that the fundamentals keep up. And so I think walking people through bond math is the easiest way, and then porting it over to equities, because indeed the largest driver of long-term equity returns is dividends. And so if dividend yields are low, which they are, 2 to 2.5% higher in international markets, you're probably going to have lower forward-looking equities. Now, I actually think the biggest thing a financial advisor can do is to get people to focus on that long-term likely destination from low starting yields, and not get fooled into thinking that, we made 20%, or stocks are up 16% this year, or they were up 30% a few years ago, and saying that means we're not in a low return environment. The two worst decades of the past 5 were the 70s and last decade in terms of stock returns. In each of those decades, you can find periods where stocks were up 20, 25, 30% on an individual year basis. You were still in a low return environment. And so it's really important that clients understand that even low return environments come with big positive shocks, and that's just because these assets are so incredibly volatile. So I think the bottom line is answer the question with some bond math first, and then make clients understand that decade-long stretches of relatively paltry returns will come with some very large individual years where stocks look like they're breaking out and we're not in a low return environment. But that's just eventually gravity takes over.
Got it. Helpful. Another question we got was, while most investors understand the long-term value of diversifying assets in a portfolio, can you give them a sense of where we are in the market cycle and when that diversification is likely to pay off?
So I can try my best to predict the future, but I think let's conceptually think about what diversification is. If you have clairvoyance, you don't need to diversify. If you know what assets are going to do, you can ahead of time pick the best asset. I don't have that ability. And indeed, I think a lot of times people say, what's the catalyst? By definition, a catalyst has to be surprising, or else it's already priced in the market. If everybody knows what a catalyst is and when it's going to come, it's already in prices. So catalysts, by very definition, have to be surprising and kind of come out of the blue. We spend comparably little time at Research Affiliates identifying catalysts. It's a hard thing to do. Sometimes, even in retrospect, you don't know what the catalyst was. Perhaps the defining moment in my 21, now going on 22 years in the business, was the unwinding of the tech bubble. Here we are 16 years later, 17 years later, I still don't know what the catalyst was for March of 2000, the reason why the tech bubble imploded. So we really don't look for, I wish I had some good news, and certainly I wish I could tell you when these diversifying assets are going to turn the corner and the cycle is going to change. But I like to say that mean reversion is unreliably reliable. It happens, but it happens on its own time frame and to its own magnitude on each individual case. But I think the good thing is the vast majority of assets that financial advisors oversee come with 10-year or longer timing horizons. So it's not, is this going to work? It's really managing client expectations.
Right. Another question we had come in, it is somewhat related. We had a question that said, what do you think of Jeremy Grantham from GMO, his comments on higher valuations persisting, and what does it mean for my asset allocation?
So we're huge proponents. Our central investment belief is that long horizon mean reversion is the best active investment opportunity you can find. Now, importantly, mean reversion means you have to identify what's the mean. And I think Jeremy was saying that, hey, look, you think some things have changed. And some of those things that have changed, lower inflation, higher profit margins, less volatile GDP growth, should mean you have higher equity valuations. We 100% agree. And I think that's the reason why when we do valuation-dependent expected returns, we're not assuming that PEs are going to go back to 16 or 17. We do assume there's a little bit different this time. And as a matter of fact, some of my colleagues actually, in a piece called The Holy Grail, went and said, what are some of the things that would lead to stocks trading at higher valuations than they have historically? And a lot of them had a lot in common with some of Jeremy's conclusions, namely that we've got lower macro volatility. What do stock investors hate? They hate uncertainty. Macro volatility creates uncertainty. If you've got less of that, stocks should trade at a higher valuation. Our conclusion, though, was not that they should trade at 30 or 40. Our conclusion was they should probably be in the low 20s, which is basically the ending value we have in that valuation dependent, which is what I assert advisors ought to use to set reasonable expectations for clients.
Great. We have a question about rebalancing. So how often should I be rebalancing my client's portfolio?
I would say the most important thing to do with rebalancing is to do it systematically and without judgment calls. I would probably say the easiest way is to do it once per year. I think that lets momentum run a little bit, and it's simple and easy for clients to understand. And when you do it every year, it just conditions them that this is automatic. There's no judgment in this. There's not, hey, let's hold off and wait till things clear up a little bit. Because inherently, the more systematic you be about rebalancing, the more likely you are to do it. What is rebalancing at the end of the day? It's a really simple exercise where you are selling your recent winners and buying your recent losers. By definition, that's a really hard thing for humans to do. And so if you condition people to do it regularly, I think on an annual basis, I think that's the best thing for financial advisors to do. You can run the numbers all sorts of different ways, and over certain time periods there may be ways that might squeeze a few basis points out of it. But I think the most important thing with rebalancing is to do it and do it systematically. And I think the more you try and add complexity to it, the more clients might be interested in, well, maybe you can run it in this way, which means I don't have to rebalance now and do the hard contrarian thing, which is to buy my recent losers. The other thing I'd say about rebalancing is, even if you've got a manager within an asset class and your rebalancing says, I need to buy more of that asset class, and that manager's done really poorly. And a lot of clients are like, I don't want to give that manager more money. What drives rebalancing excess returns is giving money to the asset class, regardless of the manager's idiosyncratic kind of volatility and returns. So don't let managers' underperformance drive or postpone a rebalancing decision. I think that's a substantial source of investors' errors.
Good. Here's a question that I've heard from advisors in the past. Does CAPE still work? CAPE being cyclically adjusted price-to-earnings ratio. And doesn't the 2008 that we have skew that ratio?
I think when we look at CAPE, indeed, the last 25 years as a timing tool, we have not seen a lot of mean reversion in CAPE, and so it has not been as effective. And so I think you can find, whether in the case of CAPE that it is a bias because of 2008, the drawdown in earnings. I think all long-term valuation ratios have some degree of holes in them. I think that's part of the reason why earlier I said find your favorite investment guru and see what they like to utilize in terms of their long-term valuation measures for the stock market. And we actually did look at 4 other measures over time in a recent paper on the CAPE methodology. And what we really found is that any of the ones that have been used over time that have had some degree of predicting equity returns over 10-year time horizons all gave you very similar rates of return, whether they're talking about market capitalization to GDP, which is Warren Buffett's favorite measure, or Tobin's Q, which is replacement value, or Hussman's PE, which takes the maximum earnings year and applies price to that. They all were pointing to low returns. And so I think if you swap one of these out and say, I don't like CAPE because of X, Y, and Z, I'm going to use another one, the chances of you getting a higher return in something that's been proven in the past, I think is relatively negligible. And that's part of the reason why I said you really shouldn't let the numbers that are produced from a forecasting methodology drive your forecasting methodology. You should really say, this is what, I think this resonates, or this is what someone who I really respect uses, and therefore I'm going to use it. And just because the numbers don't give me what I want doesn't mean I'm going to abandon it. Because if I thought it was a reasonable forecasting methodology and was telling me I was going to get 5%, now just because it tells me I'm going to get 1%, therefore I'm going to find something else, I think is dangerous and likely to paint unreasonable expectations for clients.
Mm-hmm. Historically, when has diversified outperformed non-diversified?
Well, I think we had the exhibit earlier that showed much of the last decade diversifying assets paid off, much of the mid-90s, the late 70s. So there are going to be 6, 7, 8-year cycles where diversifying assets will pay off. I think we're much closer to that. Back to the previous question, I'm not clairvoyant, but certainly a 3% expected return differential over the next 10 years means that they're pretty substantially priced to outperform. When is that going to happen? I wish I knew, or else the conversation would be a lot easier with clients. But they do go over periods of time, and I think you can look at that. I wouldn't draw too much into that. I wouldn't draw whether, is there similarities between those different markets. It's just a cyclical phenomenon, and I think you really need to have that 10-year focus and discipline to understand it, and then to make sure you're not exceeding your relative risk tolerance, and that's going through that exercise I did just a moment ago with what's the expected excess return by diversifying my portfolio, and am I comfortable with that tracking error, that maverick risk relative to the normal portfolio.
Great. This advisor asks, does diversification still make sense for a client whose portfolio is allocated in a manner that they can collect the yield or the income from that portfolio?
If anything, I think it's more relevant. If you look at the way we forecast our returns, we start with yield, and then we add in a growth element, and then we add changes, plus or minus changes in valuation. So the assets that have higher expected returns generally have higher yields, are giving us more cash distributions over time. And so I think the diversifying asset portfolio would actually provide a higher rate of return, since you're diversifying the income streams across many different asset classes that all have different return drivers and so forth. Frankly, I think you're going to get a more stable distribution of income, but that more stable distribution of income might come with a little bit more price volatility. But if your client's first objective is stability of income and ideally higher income, I think these diversifiers are actually a better portfolio than mainstream stocks and bonds. Why do mainstream stocks and bonds have such low expected returns? Because they have such low yields.
Thank you. Can you provide any comments or talking points on the notion that traditional asset class diversification is losing its efficacy?
I think when we look at long returns in the market, one of the things that's very difficult to do is to maintain a long horizon. In early 2009, over the past 40 years, bonds had outperformed stocks over a 40-year time horizon. Most people would say, "Oh, that shocked a lot of people when we put out this research." Did that mean at that particular point in time that bonds were going to outperform stocks for the next 40 years? Anybody that made a decision using that line of thinking is really regretting it 8 years in, and they'll be regretting a lot more 32 more years down the road. So we're going to go through periods where things that we're very confident there's a reasonable explanation for why these things should be additive to returns, the equity risk premium, the benefits of diversification. But there will be periods, sometimes hopefully not lasting 40 years for diversifying assets, that will test our mettle. And I don't view the last 5 years of disappointing results for diversifying assets as somehow indicating a new paradigm shift that we should really focus only on U.S. mainstream markets and not enjoy the benefits of diversification. just like in early 2009, the point of the article was not to invest all your money in bonds. It's just that these things will happen and sometimes lead to, again, that dangerous financial planning shortcut where we extrapolate recent returns, even long-term returns that really aren't illustrative of the future. I think diversification is probably at the most attractive point in the cycle, as it was probably back in 2000, 2001, right before it went on that multi-year winning streak. Now, of course, that might happen in the next year or it might happen in the next 3 years. But again, on that 10-year time horizon, we're fairly confident that diversification is a buy low opportunity.
Good. This question is, how do I know how much diversification is too much diversification for a client?
Well, unfortunately, I think a lot of people have learned that by looking in the rearview mirror with what's happened in the last 5 years. And so you have a lot of clients that could be abandoning diversification at a point in the cycle that's very disadvantageous to do so. And I think that's the reason why we're so excited to have Asset Allocation Interactive, to put out some of these publications, to work with advisors, to take calls with advisors so that we can prepare to have those conversations now before diversification inevitably disappoints, so that clients will stick with these strategies. We see massive erosion in returns from investors timing assets poorly. And a lot of the cyclicality of diversifying assets can be communicated in advance, and clients can be prepared for those. And frankly, if they don't want to do that, and that exercise points them right to 60-40, that's a great outcome. Because then they're in something that makes a lot of sense for them, and they've had a reasonable conversation. They understand the trade-off between absolute returns and relative risk or maverick risk, and they say, I don't want any of that. And I think an advisor that walks a client through that is doing more of their job than one that puts them into diversifiers that are not prepared for it. Mm-hmm. And so we do have the ability through that to, through that tool and toggling between tracking your risk to 60-40 and absolute risk to the portfolio. I think that provides a more meaningful way for clients to have conversations with their advisors and put them in the position for success, whether success is a 1% real return or a 3% real return. But what you can say is if they're in a strategy that they're not prepared for and they give up at the wrong time, returns are going to be a lot worse than positive 1% real or positive 3% real. Mm-hmm.
How long is it reasonable to wait until diversification rewards investors?
I'd say it's no different than waiting for the equity risk premium to pay off. I don't think it's 3 years. I don't think it's 5 years. And quite frankly, if you're an equity investor and you say, well, it's 40 years, the equity risk premium doesn't work in early 2009, I'm out of here. I think you really have to be a believer in diversification, and it's not a wait and see, or I'm going to give it 5 years if it doesn't work. That means that's conclusive evidence that this shouldn't be in my portfolio. I think if you're going to do a 10-year exercise of helping your clients understand how returns are likely to play, what's the ending destination of expected returns, how much variability is there going to be on the next 10 years, the journey, then you really should hold those assets for the next 10 years.
Well, thank you, John. Unfortunately, we are running a little low on time, so I want to highlight a couple of the upcoming resources for advisors before we go. So I encourage you next month to look forward to the release of Part 4 of our advisor publication series. That will be a paper on manager selection and the value that it has added, or more appropriately hasn't added, for advisors and their clients. That's followed in the series by papers on strategy selection, performance measurement, rebalancing, and taxes. That tax paper, which is going to be authored by Rob and others, happens to coincide with the 25th anniversary of a paper he wrote called "Is Your Alpha Big Enough to Cover Its Taxes?" So that is slated to be the last paper in our series and will be released in April. But if you have interest in learning more about that prior to that time, Rob will be presenting on the topic in March at our Advisor Symposium. So in addition to having Rob present at that symposium, we have several of our senior spokespeople at Research Affiliates giving talks, as well as several outside speakers, including Campbell Harvey from Duke University, Terrence O'Dean from Berkeley, and Jason Su from Radiant Global Advisors. For those of you that are interested in continuing education credits, we've also been approved for that event to provide CE credits for CFPs, and for those of you with CIMA and CPWA designations. So if you have interest in attending or learning more, please visit our advisor page on our website, researchaffiliates.com. By the way, a replay of this webinar will also be available on our website, hopefully by this afternoon. For those of you interested in receiving the presentation John just went through, an option to download the presentation will appear on your screen momentarily. Before you go, we always appreciate feedback. We have a short 1-minute survey that will appear on your screen. So we hope you can spend some time giving your thoughts and letting us know how we can make it better in the future. Thanks again for being with us today.